It's Wednesday, March 3rd. This is The Street Live. I'm Catherine Ross, and I am joined, as always, by Jim Cramer. Jim, what are you currently watching in the markets?
Look, I think the market is terrible, okay? One of the reasons why it is terrible is because what's going on is that they're throwing away anything that had done well last year at this time and embracing a whole group of stocks that did terribly. So you have a lot of stocks that just can't get out of their own way. I mean, there was a fantastic piece today about Alphabet and how it's doing well in this cloud, Google Cloud Services. And you knew the stock was going to get hammered, even though the piece was incredibly important. And I mentioned that because when oil's up $1, you're getting everything going wrong in terms of if you have a portfolio that's made up of growth, and everything going right if you have a portfolio that's made up of industrials. And there are not enough industrials in this market to make it so that you can have a real rally other than in the Dow Jones. And the Dow Jones leader, once again, is Boeing, which is a huge position of ours. We have other positions that we've been taking action on ahead of the conference call, which I've been working furiously on. But this is a market that is taking no prisoners when it comes to anything that was doing well last year.
And of course, that members-only conference call will air tomorrow at 11:30 a.m. over on ActionAlertsPlus.com. Jim, one of the biggest high-flying stocks yesterday was Rocket Companies, which did have quite the rally. And today it's down. It's down about 18% to $34 a share. And you tweeted about the large short interest in the stock.
Yeah, I mean, CNBC said it was 45%. I had it at 38% from Bloomberg. But what matters is that I don't know why people were shorted. Now, when you talk about this is a meme, Wall Street bet stock, I don't understand why people didn't buy puts on it instead of being shorted. And immediately that was contradicted by people who just think I just don't know. They used to teach options. It was just a way to be able to limit your risk. But they didn't. They were short common. And because they were short common, I'm sure that there were some firms that went bust yesterday. We don't know who. And we also don't know any names, unlike Melvin Capital. But we do know that it was a dumb short. And the reason why it was a dumb short is the company's doing really well. And it reported special dividend. They had great numbers. And I could see that someone says, with rates going up so much, maybe they're going to do poorly. But the company demonstrated when they reported the quarter that when rates go up, they still do fine. So there was really no short thesis. I mean, I can understand a short thesis in GameStop. If you don't have Ryan Cohen in there agitating, it's entirely possible they were just going to continue to do what they were doing, which is to not do well. But when it comes to Rocket, it was doing well. So why were people, what is a great short case? If rates are really going to go higher, find something, and maybe people were short Rocket versus, say, long JP Morgan or something. I'm thinking that, let's get rid of let's only bet against the mortgage part, but it didn't work. And I think that people have to learn a lesson, which is that when you see a short that's as crowded as this, then the Wall Street bets people are going to go after you. And I talk about this in the conference call tomorrow. Wall Street bets are a very powerful force. So you shouldn't be in a gang tackle short. You're going to lose money.
Yeah, and Jim, I'm glad that you covered it from the short angle, because there's another angle to the story that I'm not sure is getting covered as much, but it's really murky, right? So a lot of the informational websites that you can go to try to find what stocks are being talked about the most on Reddit's Wall Street Bets you don't quite know where the sourcing is coming from. So you have to kind of dig through the Reddit thread yourself. But even then, it's not quite certain where all these traders and all this interest came from in Rocket. It is interesting because there were a couple of posts, but not quite as many as the GameStop posts that we continue to see on the subreddit.
All you have to do is follow my Twitter feed. Now, other than the people who unfortunately I had to block because they were scatological, people were pumping Rocket endlessly, like the UWMC, which is another one that they're pumping. Now, they could say, well, listen, Jim, we're not pumping. We're just talking very positively about it, and no different from any Wall Street analyst. And I get that. You could say that. But I was deluged with tweets about how Rocket was next. And that's what made me say on Squawk on the Street, well, it's got a 38% short, which is the number I knew. And so I imagine people would go after it. And did I start this? Absolutely not. I just managed to see it. And I feel strongly that when you see it, people are going to act on it. And so any stock that has a big short position, for those who are watching, cover your short. Okay, just cover it. Because I think that you're next.
Speaking of being able to see stocks that are being eyed on social media platforms, Dave Portnoy is helping to launch the VanEck Social Sentiment Buzz ETF. Now, this ETF will focus on what stocks are being talked about and on both social media and the internet in general. I mean, Jim, it's interesting because I'm looking at some of the index holdings and they're names that you like. So we're talking Plug Power, Square, Ford.
Yeah, well, I mean, yeah, this is they use AI to monitor 15 million online posts. We have an excellent article on it today in TheStreet for those who are trying to learn more about it. Barstool Sports El Presidente, Dave Portnoy, helping to launch Buzz ETF. GameStop, unfortunately, didn't make the cut this time, I think because it wasn't big enough when they put it together. I think that will change. Dave is a colorful figure. I have followed Dave. Dave went to my restaurant. You know, Dave has a couple jobs. I mean, remember, he does one, one bite. And what I love about Dave is he used his personality to raise a lot of money for small business. And so some people may think that he's all about joking around. I think he's all about running a fantastic book, sports book. It's why I've been recommending Penn National endlessly. And he's about restaurants. Of which, by the way, is a very fun thing that he does. And I've enjoyed his company. I've gone to a game with him. I like his success. And this is part of it. And I think that he has buzz himself. I also think that because of what he's done for small business, those who are critical of him, I think should look at his whole holistic personality, because there's a lot that he does that's very good.
Yeah, and just to add to that, Jim, he's been one of the few, before we even were talking about Wall Street bets in all media, we were talking about Dave Portnoy and when he jumped into the markets and really started with Davy day trading, talking about what he was interested in. It definitely kind of changed the tone and probably brought on more retail investors.
Well, I think that one of the reasons why I like Dave is he doesn't take himself too seriously. The people who took up a lot of his trading do take themselves very seriously. And I think that money is serious, so I totally get that. But the tone is quite different on Wall Street bets than the tone that Dave has. I mean, Dave also plays with an open hand. You can see everything that he does. He is not a suit, so to speak, but he doesn't make those sweeping observations. He takes it as they come and as the chips fall, which I like, because not everybody, just because you wear a suit doesn't make you a jerk. Another thing that Dave does that I think it is sensational is when he set up interviews. Like, for instance, when he went after Vlad Tenev in a Twitter interview, it was really one of the most exciting things I've seen, because Dave was pulling no punches, but Vlad handled himself very well. And at the end, of course, Dave did not wish Vlad good luck and doesn't think Vlad's going to make it with Robinhood. I think that that Robinhood has the money to do it, and I actually am pro Robinhood. I am not pro what happened those last days. But remember, I know people are angry, but they did allow you to sell GameStop. You couldn't buy GameStop. And remember, GameStop was considerably higher than it is now. So, you know, the notion that you got hurt is different from the notion that they did wrong. And I think that everybody has the right to trade. So they did that wrong. There was this VAR, this concept of how much they had at risk that was insane. And a lot of it, believe it or not, was AMC. It was not GameStop. But I think that Dave, with this Buzz, B-U-Z-Z, is going to have an ETF that I'll check all the time. Now, I think one of the things that's happened in this market is that people check Cathie Wood, because she sends out her note after 6 o'clock, and you see what she buys. It's kind of, again, prurient is the way I describe it. I just saw her yesterday. She's always selling one of our stocks. It drives me crazy. But, you know, she uses like a Bristol Myers as a place to park cash. And then you've got this, which is AI driven. And so there's a lot of new things to watch if you're an investor that are quite different from what we've used to watching in the past. Some of the things of which I'm going to touch on in tomorrow's talk.
So I want to talk about Cathie Wood, Jim. She bought over $95 million of Zoom yesterday. Now, we talked yesterday about when investors could buy Zoom, but what do you make of her buy the dip strategy now that we've seen in both Tesla and Zoom?
Well, I mean, look, I thought Zoom was good. It was good, and they gave you a very good path. But Zoom is, I misjudged the hatred of even the best ones. So in other words, I thought that the formula was, if you reported much better than expected quarter, and then you raised your forecast dramatically, your stock had been going up. That ended when we saw this last rate increase. I mean, last interest rate increase, not Fed. And so what happens is that Zoom, which is now down is down 220 points from its high, is a company that people don't think is worth 100 billion anymore. Now, what is Zoom worth? I don't know. It's worth whatever it sells for, but we certainly are in a market now that's very not. I don't want to call it unforgiving because Zoom did good. We're in a market that just doesn't like certain stocks, and Zoom has now been turned on. Now, how long does this last? This period? It may not last very long. I mean, I'll be talking about that tomorrow. But as it lasts, you have to be willing to take pain. I'll give you an example. NVIDIA is down another 12. Now, NVIDIA was a company that gave you great forecast, gave you great data, really terrific data center, even though some people felt that it wasn't. That's just wrong. Like, we clarified that when Jensen Huang was on our show. And it also has an Ethereum card that's going to be coming out. And you'll be able to buy that if GameStop takes my idea, and I think that Ryan Cohen might, because Ryan Cohen apparently is a very open-minded person, and I have a great relationship with Chewy, then I think you have a great Bitcoin play for GameStop. But no one wanted to hear about Bitcoin, Ethereum, I mean crypto. They didn't want to hear about crypto because on NVIDIA because there was a great conference that we held at TheStreet where I said, I think NVIDIA is going to miss the quarter. And that was because they had so much crypto and they had big crypto inventory. This is going to be different this time. And what I would stress to the people who run GameStop is go take all the crypto that NVIDIA makes and sell it at your 5,000 stores or close the ones that aren't worth it and become a training ground for how to mine crypto and how to buy crypto. Do a deal with Square. Square allows you to buy a little bit of crypto, which is one of the reasons why people were saying, Jim, you were lukewarm on Square. Suddenly you like Square. Well, Square developed a bank. I didn't expect them to develop a bank. And the bank makes it so that they're going to be able to get the deposits of a lot of restaurants, which typically, after you use the point of sale, went to Chase in New York or went to your local bank. And I think that what we're looking at is, a wholesale revolution that of crypto and of Ethereum that could really make GameStop a lot of money. So I'm sticking by that. I like Buzz. GameStop's fun to watch. It was fun to watch Rocket. And I think that when I say fun, I mean that it's great to watch people make money at that speed. I'm going to talk with my conference group tomorrow about how difficult that really is to do because there's only so many stocks that have gigantic short positions.
So let's talk about a CEO that you sat down with last night on Mad Money. You sat down specifically with Canopy Growth CEO David Klein about their partnership with Constellation and his outlook on cannabis in the U.S.
I'm glad you brought that up. Now, there are two kinds. Well, there's these. There are people who love the marijuana stocks. Okay, and what do they love about them? They think it's going to be a gigantic industry. I don't. I used to think it was. I don't. And why I don't is because it's going to take a long time to happen in the U.S. But the people at Canopy are very related to the people at Constellation. And what people have to recognize, having been in this business and in this business now, is that you have two components of successful alcohol, or in this case, successful cannabis drinks. You have the taste, and more important, you have the distribution. And Canopy is going to be able to use Constellation's Modelo and Corona distribution in order to get this to you. And that's all you need to know. The other guys don't have that. Now, I've always wondered, why do people hate Canopy? I mean, David Klein was the CFO of Constellation, just brilliant. They brought him over there to clean it up. Now, Canopy was poorly run, really poorly run, and spent a fortune, stupidly. But it's not doing that anymore. And the numbers that that David's talking about doing would indicate that you have to buy it. But people want these other ones. They want there's always one that they want. They'll be like Green Thumb, or they'll want the Afria. I mean, there is endless number of people who like the other ones and have really tried to dissuade me from getting involved with Canopy. They like Irwin Simon's Afria, which has done incredibly well and is doing it's but $6 billion market cap, making money, and that's fine. I think there's room for a bunch of them, but not that many. There will be far fewer ones than there are now. But I like Canopy because of the balance sheet, because I think that you have to wait out the U.S. Making it so it's legal. And if you're going to wait out, you need a balance sheet. That's what I think.
So, Jim, let's talk about your mad dash this morning, which is Dollar Tree. They did top fourth quarter earnings, but they missed on revenue. And you noted this morning that it didn't do as well as people had hoped when making the assumption that this is a Dollar Tree market. So I want to pose this question to you. Is this a Target and Walmart market?
Really? No.
Do you think it is?
No, I'm getting killed in Walmart.
Well, but you've said on our Action Alerts Plus videos that that Walmart's under a lot of pressure, but I'm wondering from the consumer angle is what I'm trying to get at, Jim. What do you make of where people are shopping? Because what I'm seeing is more people.
Walmart, but it doesn't matter. I mean, it's a hated stock. It's going straight down, as is Costco. There's not a day it doesn't go down. So there are just gigantic sellers, and the sellers are relentless. Oil up $1.70. That's not going to help the market. The sellers are relentless. They don't care. They don't care what price they sell. They just don't. Very similar, by the way. Let's go over the ones that they don't care about Crown Castle. There's no price that they won't sell that because of interest rate play. And it's one that we bought with has a yield, but it's just a disaster for our club, and I feel terrible at that. It's just nonstop selling, and I don't really think that these companies deserve that, but they are in the crosshairs of the people who want to sell anything that involves interest rates and involves the competition. I mean, here you've got Crown Castle, which is going to get a huge amount of business from the companies that need to be able to have 5G, and it made a lot of sense. And you also had Elliott Management in there, and I'm trying to figure out what to do. I don't want to buy anymore until it gets to 140. The insider buying there is probably the most aggressive of any company we follow. I mean, think about that. The most aggressive of any company we follow. So I'm not bailing. But it's got that Viacom feel. And when the push came to shove, I cracked on Viacom. I've said that. I cracked because I felt that there was something that I didn't know. And I did. I was right. But I was wrong in what I did, but I was right in the thesis. And my thesis is very good for Crown Castle. My thesis is very good for Walmart, which is that Walmart is now almost back to where it was before the darn pandemic. And that's crazy. It's doing very, very well. But we are in a market that's unforgiving because COVID's over, according to everybody. Get Alex Gorski on last night. The pandemic will end in June. And if the pandemic ends in June and you have Walmart, this is very interesting when you talk about Walmart. When you look at Walmart, I mean, here's a company that announced some really good numbers but said it's going to spend. Walmart was at 153. It's at 128. It's down 10% for the year, which is really incredible. It's one of the worst acting stocks, and it still gets no buyers. Now, that's because all of the companies that are essential year over year are not going to be able to do the same numbers. And people just want to get ahead of that. We're too early. Too early could be a synonym for wrong, but I'm not giving up.
So, Jim, the rush to reopen is ill-advised is actually the title of your Real Money column that solemnly warns this morning that Texas and Mississippi rolling back their mask mandates perhaps came a little bit too soon and that this could have an economic impact. Now, especially when looking at restaurants, Jim, how badly could this hurt these two economies?
Well, people have to understand that if you don't put through the right aerosol, then what happens is that if a person's sick at the back of the restaurant, it's going to make somebody sick in the front of the restaurant, which is why I still won't go to a restaurant. And I've had 2 Modernas. My wife has not been vaccinated. And I just feel very strongly that you simply wear a mask when you're not there, and that the idea that Texas is open when they've vaccinated 7% of the people is the kind of thing that happened under Trump. Where you had every state every man for himself or woman for himself, and that's not how you conquer a pandemic. It is how you run the show The Apprentice.
I agree with you there. So let's end on that note, Jim. Thank you so much for joining us today, guys. We're now heading on over to our Action Alerts Plus daily rundown show over on actionalertsplus.com. And do not forget that tomorrow at 11:30 a.m., Jim is going live to break down what you need to be paying attention to in the markets. We'll see you then.